Okay, so professors, we have looked at the first four. Continuing, we have the next one, which is when the owner takes goods for private use. So Bridget, I hope now you can hear me. So you do the reading for us on this slide. Oh, Bridget, I think my line is breaking again.
Goods taken for owner's private use refers to value of stock used by the owner for the business for his or her own private purpose. Accounting treatment in the final account, trading account, it is deducting from the purchases. Balance sheet, adding drawings and deduct from capital. Cash withdrawn from owner's private use. Accounting treatment for the final account. Balance sheet 1. It is deduct from the cash balance. Balance sheet 2. Added to drawings and deducted from capital.
Okay, thank you very much, Professor Bridget Obeng. Okay, so as she read it, professors, you have to remember this too. What is it about? An owner doing a business, a sole proprietor for that matter, can take some of the goods. For example, the person is buying and selling Kivo Gari. So the owner can take some of the Kivo Gari and chop it. If you do that, remember in business, the owner is separate from the business, right? That is difficult with sole proprietors, but even in law, we try to separate them. The owner is different from the business. Okay, so we see that to be drawings. Anytime the owner takes anything for personal or private use, it is seen as drawings. So how do you treat this? The first treatment is in the trading account. So what we do there is to subtract or deduct the quantum or the amount of goods the owner took from the purchases figure. So professors, I'm drawing your attention to the trading account. Okay, you remember where we put purchases. You go and less the goods withdrawn. So under your cost of sales, when you bring the opening stock, add purchases. You see that you do something to purchases, you less return outwards, add carriage inwards. Additionally, you less any goods withdrawn by the owner in the trading account. So it means you have to less it before you get the net purchases. Then in the balance sheet, this is drawings. So you know what we did with drawings in the balance sheet. We deducted from capital. So you will include that amount of goods the owner took for private use and deduct from capital as drawings. If it is cash, remember cash is a current asset in the balance sheet. So if the owner took cash, we would first deduct it from the cash under the current asset and again take it as drawings and deduct from capital. So that is if the owner takes any goods or cash for personal use. What if the owner adds his or her private expenses to that of the business? So that is the proprietor's private expenses charged against the firm's expenses. That is also another form of drawings. So what we do is that in the profit and loss account where the expenses are, we will deduct it from it. So an example, let's say the total rent in the trial balance for the business is 1 million. And then you are told in the additional information that the owner added, let's say, 200,000 of his personal property to the business rent. So when you are preparing your profit and loss account, when you quote rent, you don't have to put the full 1 million there because a portion is for the owner. So you deduct that portion of the owner's expense. And then again, you take it to the balance sheet as drawings to deduct from the capital. Okay. Now, I think I'll leave this, the provision for depreciation, provision for bad debt, and then I'll leave the provisions, okay, for a later day because that is quite technical. So we can do the interest on loan. Interest on loan. Who is doing the reading for us? Prof. Fifi Asian. Prof. Fifi Asian, please do the reading for us on the interest on loan.
Say. Interest on loan. Accounting treatment in the final account, profit and loss account. The interest charged for the current year is debited or added to the expenses. Balance sheet. Any outstanding or unpaid interest at the end of the year is shown as a current liability.
Okay. Thank you very much, Prof. Fifi Asian. So, professors, what we are saying here is that if a business goes for a loan from a bank, you pay an interest. It normally comes in the form of 10%, 5%, or whatever per annum. So what you do is, to determine the interest, you apply the rate. If it's 10%, you multiply that 10% by the amount you took. So, for example, if Mr. Amwa goes for a loan from GCB Bank, 50,000 Ghana cedis, and GCB says I'll pay 5% interest on this amount of loan. To determine the interest, I multiply 5% by 50,000. And I think I'll get somewhere around 2,500 as the interest on this loan. So we are saying calculate this interest, okay, and put it in the profit and loss account as an expense. Then in the balance sheet, pay attention, any outstanding or unpaid interest. So if out of the 2,500, I might have paid 1,000 to GCB, then the outstanding will be the 1,500. That is what I will show in my balance sheet as a current liability. Okay. If at the end of the year I have not paid any, I've paid nothing out of the interest, then the full 2,500 will go into the balance sheet as a current liability. So for the interest on loan, you always have to satisfy yourself whether the business has paid something or hasn't paid anything. In cases where the business has made some payment, you need to know how much is outstanding to take it to your balance sheet. Okay, so that would lead us to, I think this will be the 7th. So we'll leave the bad debt, provision for bad debt, probably to the next class. So let me take us to an illustration where we'll see this thing manifesting and how we would go about in adjusting them. So by way of quick recap, any of my professors to tell me what we've done so far, or you just mention them for me. The adjustment that we've looked at, just mention them for me. Who is going to do that? Prof. Portia.
Sir, please, we've done the accrued expense, which is also known as outstanding due or owing. We've done the accrued income, prepaid expense. prepaid income, service, that sort of thing.
Okay, so she has mentioned the prepaid income, prepaid expense, accrued income, accrued expense. Who else is adding on the remaining? Because we've done like 7. Who else is doing the remaining besides Portia or aside Portia? Okay, let me add on myself. So the remaining was the owner's drawings, as in the owner taking goods, taking cash, and then the interest on loan, and the owner also adding his or her private expenses. So these are the 7 illustrations we have, or adjustment we have seen. Let's look at this example here. And please open your eyes well, because I'm going to be asking some small questions. Okay. So you see here, right on the screen, you see the trial balance of Obina for the year ended 31st December, blah, 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 2016. And you see the trial balance being given here from capital, drawings, opening stock, purchases, sales, returns, this debtors, creditors, rent, salaries, rate, insurance, telephone, furniture, provision for depreciation, machinery at cost, provision for depreciation of machinery, commission, cash, loan, bad debt, bank. So this is the trial balance. I think you are familiar with this one. Now look at something here, additional information. And this is the section of interest to us as far as adjustment to final account are or is concerned. So the first one is closing stock. We are familiar with closing stock. Now look at this one. Commission unpaid. Commission unpaid. Commission unpaid. You have provision for bad debt. That one I said we should hold on. You have telephone outstanding. You have accrued salaries. Accrued. You have rent was received in advance. You have the owner withdrew 2,000 worth of goods for private use. You have the owner took from bank 9,000 naira for personal use. You have interest on loan is at 10%. You have bad debt provision for depreciation. So I said, let's keep those 3 for a later date. But professors, you appreciate that all the things that we have just gone through are manifesting in this question, where we are given additional information about some expenses. Oh, the network. Okay. So, professors, I hope you didn't miss the point.